The United States Strategic Petroleum Reserve currently sits at its lowest operational level since the early 1980s, following multiple rounds of emergency releases. This depleted energy reservoir functions as a hollowed-out fortress wall standing against a rising tide of global geopolitical instability. Financial analysts observe that the closure of the Strait of Hormuz represents the ultimate systemic shock to the global commodity complex. Approximately 20% of the world's daily oil consumption passes through this narrow maritime corridor in the Middle East. A sustained disruption in this region creates a parabolic move in energy prices that fundamentally alters the cost of all industrial production. The chief analyst identifies the current spike to $110 per barrel as the primary catalyst for a silver short squeeze. Wall Street has historically treated silver as a speculative asset that can be suppressed through the use of paper derivatives. However, the mechanical reality of the energy market is now overriding the digital illusions of the New York trading desks. Energy represents the single largest input cost for the extraction and refining of physical precious metals. Every ounce of silver pulled from the earth requires a massive expenditure of diesel fuel and electricity. When oil remains above $100, the floor price for silver production rises in direct mathematical correlation. The chief analyst notes that most primary silver mines are currently operating with paper-thin margins at the $80 level. A transition to $110 oil pushes the all and sustaining cost of these mines above the current spot price. This creates a structural deficit where it is no longer profitable for corporations to sell silver into the open market. The analyst highlights that silver mining is an incredibly energy-intensive process involving the movement of thousands of tons of rock. Crushing and processing this ore requires a constant and expensive supply of high-voltage electrical power. As global energy costs surge, the global mining sector is forced to either raise prices or cease operations entirely. The Strait of Hormuz crisis ensures that these high energy costs are not a temporary spike, but a long-term reality. Institutional short sellers are currently trapped in a position that assumes a return to low inflation and cheap energy. The chief analyst observes that these institutions are holding billions of dollars in paper contracts that they cannot fulfill with physical metal. The cost of shipping physical silver across the ocean is also rising due to higher maritime fuel surcharges. This logistical bottleneck adds a hidden premium to the physical metal that is not reflected on the digital ticker. The Hormuz Trap is the realization that the global supply chain is only as strong as its weakest energy link. The analyst explains that the silver market is currently in a state of historic physical tightness. Exchange vaults in London and New York are reporting a consistent and massive drain of registered inventory. Smart money investors are front-running the energy crisis by securing physical bullion before the squeeze intensifies. They recognize that $110 oil is the ultimate signal for a currency debasement event. Central banks are likely to respond to higher energy prices by printing more fiat currency to subsidize consumer costs. This increase in the monetary base further devalues the dollar and drives the price of hard assets higher. The analyst maintains that silver is the most undervalued asset in the world relative to the current money supply. The Sunday evening opening will likely reflect the panic in the energy markets as traders scramble for safety. A massive gap up in silver is the only logical outcome when the cost of production doubles overnight. The chief analyst observes that the technology sector is also feeling the pressure of higher energy costs. Manufacturing semiconductors and solar panels requires an immense amount of stable electrical energy. Silver is the non-negotiable element that ensures the efficiency of these high-tech systems. As energy becomes more expensive, the efficiency provided by silver becomes even more valuable to the industrial giants. Wall Street wants to maintain the $80 ceiling to protect their short positions from total liquidation. But the Hormuz Trap has effectively removed the ceiling and replaced it with a rising floor. The analyst notes that the geopolitical tension is causing a move toward resource nationalism. Nations that produce silver are increasingly reluctant to export their wealth in exchange for devaluing paper digits. They would rather keep the metal in the ground until the price reflects the true cost of energy and labor. The chief analyst maintains a strictly professional and data-driven perspective on this transition. The numbers clearly show that the era of cheap silver was subsidized by cheap and abundant oil. That era has ended with the closure of the Strait of Hormuz and the move to $110. Institutional traders who ignore the energy component of the silver trade are inviting a catastrophic loss. The short squeeze is no longer a matter of if, but a matter of when the margin calls begin. The analyst concludes that the current environment is a perfect storm for the silver bulls. Low inventories and high demand and skyrocketing energy costs are the three pillars of the next rally. The Hormuz Trap is the final trigger that will launch silver into the triple digits. Investors should watch the crude oil ticker as a leading indicator for the next move in precious metals. The connection between the two has never been more critical for wealth preservation. The chief analyst remains focused on the structural shifts that define the global economy. Silver is the essential heart of the industrial world, and energy is its lifeblood. When the lifeblood becomes expensive, the heart must beat faster. The silver squeeze is the mechanical heart rate of a global economy in transition. The second phase of the global silver revaluation involves the total breakdown of the paper to physical pricing mechanism. The chief analyst observes that the current pricing model for silver is based on a massive volume of leveraged contracts. These contracts represent thousands of ounces of silver that do not exist in the physical warehouses of the exchanges. This fractional reserve system functions efficiently only during periods of geopolitical and economic stability. The Hormuz Trap has effectively shattered this stability by introducing an unquantifiable risk to the global energy supply. When oil reaches $110, the cost of maintaining the status quo becomes too high for the banking sector. Institutional risk management teams are currently forced to adjust their volatility models to account for the energy shock. The analyst notes that the liquidity in the silver futures market is starting to dry up as major players exit. Short sellers are finding it increasingly difficult to roll over their positions without attracting massive buying pressure. The chief analyst highlights that the industrial demand for silver is now competing directly with the investment demand. High energy prices have accelerated the global push for renewable energy sources like wind and solar. Every new solar installation requires a significant amount of silver to convert sunlight into usable electricity. This means that even as the price rises, the demand for the metal remains stubborn and price insensitive. The analyst explains that the silver market is currently experiencing a classic supply-side shock. Higher fuel costs have forced mining companies to high-grade their deposits, which reduces the long-term life of the mine. High grading is the practice of only mining the most profitable ore to offset the rising cost of diesel and electricity. This strategy provides a short-term boost to production, but ultimately leads to a faster exhaustion of the global reserves. The chief analyst observes that the total annual mine supply of silver has been stagnant for nearly a decade. There are very few new silver mines coming online to replace the aging facilities in Mexico and Peru. The Hormuz Trap ensures that the capital expenditure required for new projects will remain prohibitive. No rational mining executive will commit billions of dollars to a new project when energy costs are unpredictable. This lack of investment ensures that the silver deficit will continue to grow for the foreseeable future. Wall Street is aware of this deficit, but they are incentivized to maintain the illusion of abundance. They use the paper market to push prices down during periods of low volume to discourage retail accumulation. But the analyst recognizes that the retail public is becoming more educated about the macroeconomics of silver. The demand for physical coins and bars has reached record levels in the United States and the European Union. American investors are seeing the chaos in the Middle East and the rising gas prices at the pump. They understand that silver is a tangible store of value that cannot be destroyed by a geopolitical conflict. The chief analyst notes that the premium for physical silver remains high even when the spot price is suppressed. This disconnect is the first sign of a total market bifurcation between the paper and the physical metal. The Hormuz Trap will likely lead to a force majeure event on the major commodity exchanges. A force majeure occurs when the exchange is unable to fulfill its delivery obligations due to circumstances beyond its control. If the Strait of Hormuz remains closed, the physical delivery of silver will become a logistical impossibility. The analysts suggest that the exchanges will be forced to settle their contracts in cash rather than metal. This would lead to a massive spike in the price of physical silver as everyone rushes to secure what is left. The chief analyst maintains a strictly objective and data-driven approach to this systemic risk. The correlation between oil and silver has reached its highest level in 30 years during this crisis. Energy is the master resource that determines the price of every other commodity in the global basket. When the master resource becomes scarce, every other resource must be revalued higher. The analyst concludes that the silver shorts are effectively betting against the laws of physics and thermodynamics. You cannot produce silver without energy, and you cannot have cheap silver with $110 oil. The Hormuz Trap is the physical manifestation of this fundamental truth. Wall Street will eventually be forced to capitulate and buy back their silver at much higher prices. This capitulation will provide the fuel for a vertical move that will surprise the entire financial world. The chief analyst provides this insight to help investors navigate the most volatile period in modern history. The data clearly points to a silver squeeze that will redefine the precious metals market. The closure of the Strait of Hormuz is not just an energy event, but a monetary revolution. Silver is the leading edge of this revolution because it is the most critical and undervalued asset. The analyst maintains that the current price of silver is a historic gift for those who understand the energy link. The opportunity to acquire physical metal at these levels will not last long once the margin calls begin. Institutional desks are already starting to shift their focus from selling to strategic accumulation. The Hormuz Trap is the catalyst for a global wealth transfer that will favor the physical holder. The final part of the analysis focuses on the long-term implications of the Hormuz Trap for the global monetary system. The chief analyst observes that the United States dollar is the primary currency used for the global trade of oil. The current crisis in the Middle East is a direct threat to the petrodollar system that has dominated since the 70s. As nations move away from the dollar to settle their energy debts, the demand for neutral reserve assets will explode. Silver and gold are the only assets that have no counterparty risk and are accepted by every nation on Earth. The chief analyst identifies the current oil spike as the final bell for the era of unbacked fiat currency. Central banks are currently in a trap of their own making as they struggle to manage inflation and debt. They cannot raise interest rates high enough to combat energy inflation without triggering a massive debt crisis. The only option left is to continue printing money, which will further erode the purchasing power of the dollar. Silver is the natural beneficiary of this monetary chaos due to its dual role as money and an industrial metal. The chief analyst notes that the gold to silver ratio is currently at a level that is historically unsustainable. Silver is extremely undervalued relative to gold, which suggests a massive move to the upside is imminent. The Hormuz Trap provides the geopolitical pressure needed to trigger this long-awaited revaluation. The analyst points out that the global silver market is incredibly small compared to the global oil market. A tiny fraction of the capital leaving the energy or bond markets would be enough to double the price of silver. The analyst observes that institutional money managers are starting to allocate a portion of their portfolios to silver. They recognize that silver offers a unique hedge against both inflation and geopolitical risk. The chief analyst maintains that the $80 level was a significant floor that has now been fortified. The Hormuz Trap ensures that the cost of mining and shipping silver will remain elevated for years. Wall Street is currently attempting to distract the public with volatile moves in the tech and crypto sectors. They want the retail investor to chase the latest hype while they quietly secure the physical commodities. But the analyst sees through the noise and focuses on the fundamental reality of supply and demand. The silver deficit is a physical reality that cannot be solved by a digital algorithm or a media headline. The analyst highlights that the demand from the medical and telecommunications industries is also growing. Silver is used in everything from advanced surgical tools to the high-speed circuitry of the global data centers. High energy prices make the recovery and recycling of silver from electronics more expensive and less efficient. This further reduces the secondary supply of the metal and increases the reliance on primary mine production. The chief analyst observes that the silver miners are now the gatekeepers of the technological future. They hold the key to the materials needed for the AI revolution and the green energy transition. The Hormuz Trap has effectively handed the leverage from the banks to the resource producers. The analyst suggests that we are entering a period of massive consolidation in the mining sector. Large-cap gold miners are looking to acquire silver assets to diversify their portfolios and hedge against energy risk. This corporate activity provides a secondary boost to the valuations of the silver mining stocks. The chief analyst concludes that the silver squeeze is the inevitable outcome of decades of market manipulation. The paper market has been allowed to drift far away from the physical reality of the Earth. The Hormuz Trap is the event that forces the two markets back together in a violent and sudden move. Wall Street will try to blame the squeeze on speculators or outside agitators to avoid responsibility. But the analyst knows that the squeeze is the result of a fundamental energy imbalance in the system. You cannot have a functioning modern society without energy, and you cannot have a modern society without silver. The price of both is headed significantly higher as the global supply chain ruptures. The chief analyst maintains that holding physical silver is the most prudent strategy for the current era. It provides a liquid and portable store of value that is independent of the banking system. The Hormuz Trap is a warning to every investor that the old rules no longer apply to the new reality. The transition from paper wealth to hard assets is accelerating every day that the strait remains closed. The analyst provides this comprehensive brief to ensure that you are on the right side of this historic move. The data is clear, and the logic is sound, and the energy link is undeniable. Silver is the ultimate coiled spring of the financial world, and the oil spike is the release. The next silver squeeze will be the largest and most sustained in market history. The chief analyst will continue to monitor the Strait of Hormuz for any signs of de-escalation or further conflict. But as long as oil remains above $100, the silver squeeze is a mathematical certainty. The era of truth in the commodity markets has finally arrived through the Hormuz Trap. Investors who act today will be the ones who thrive in the world of tomorrow. The analyst concludes this report with a focus on institutional integrity and objective reality. The world is changing, and silver is the constant that will preserve your financial future.